All right, why don't we go ahead and get started? So my name is Mark Lamonic. I'm the product manager for Morningstar Premium, morningstar.com.au. So the people that have attended these before will notice I'm in a different room. So I've been abandoned by everyone. But the exciting thing is you can see a view behind me of that's where my team sits. You can notice all the chairs are empty. They're probably all out for a long lunch, which I guess is good. At least I taught them something. But anyway, today we're going to talk about portfolio construction. So no Will today. He's filming something else. And Shani is still on leave. Today's actually her birthday. So if you want to wish Shani a happy birthday, send me an email or listen to Investing Compass. That'll make her happy. But yeah, anyway, portfolio construction. So some housekeeping items first. A couple things. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer any personal advice, but I still would like questions. So if you have any questions, there's a Q&A button on your Zoom screen. So hit that, send through any questions. You can send them through the chat function as well. And we'll get into those. And then this will be recorded. It is being recorded. Obviously the quality isn't that great because it's just an automatic camera in this room. But we will post that probably tomorrow on the website. So I can show you at the end where to find that. And if you have any other questions, just email me at mark.lamonica1@morningstar.com. So I'm going to share the PowerPoint. All right, so as I said, we're talking about goals-based portfolio construction today. So a couple things before we get into this. Number one, hopefully this should be obvious, but all of us are investing for a reason. And that reason, the whole reason that we save and invest is because there's something in the future that we want to spend our money on, right? So the whole act of saving and investing is just delayed gratification. So anytime you start thinking about investing, and the reason that I give that statement about personal advice is because of regulations, but also because everybody's investment plan should be different. It should be based on your own personal circumstances. And that's what we're going to talk about today. So at Morningstar, we have this saying that we're about the investor and not the investment. And that's how all of you should think about investing. So the whole industry is very product first, trying to sell you on different products, but it should be about you and what you're trying to accomplish. So we're going to go through that process today. All right, so in order to set up a plan for goals-based investing, first you need a goal. So one thing you can have multiple goals. We all do have multiple goals. So retirement's generally a goal that a lot of people have, but there are all sorts of goals in between, and all sorts of goals afterwards. So whether that's buying a house, whether that is going on a trip, there are all sorts of different goals that people have. We have a comment already about soft furnishings will reduce the echo. That is probably true, but nobody asked me about furnishings, not even in my own place. But as I was saying, so goals. What do we have to do with a goal? We have to be very specific about what that goal is, or none of this works. This whole process we're going to go through today won't work. And people hate doing this because people get very nervous about actually defining their goals. Because as you'll see, if you define your goal, you may not be able to actually accomplish it without some sacrifice, like saving more money. But anyway, we're going to get very specific about the goals. The one thing that I will say before we get into this process is that while it's important to be specific, your goals can also change, and you can adjust them as you go through life. But just going through this example or going through this process will actually allow you to make some better investment decisions. So you should try it. So 4 things you need to define to figure out what your goal is. How much will your goal cost? So that's very important, right? You're saving money for something. You want to translate that money into something. What's that going to cost? And we put in parentheses, remember inflation. So really important, especially if you have a long time horizon. Things are not going to cost the same as they cost now. So that's important. When do you want to achieve your goal? Once again, this can change. If you are 25 and you set a retirement date, it doesn't mean you need to retire on that day. You can adjust that over time, but you do need to actually set a time period for when you want to achieve this goal. Very simply, see what you have now. I mean, I say this is simple, but a lot of people have no idea what's in their super. And of all sorts of different supers all over the place from previous jobs, but spend some time figuring out how much you actually have right now. And then look a little bit at your budget, your salary, what's coming in, what's going out, how much you can actually save. Now, this is a good exercise to start with, and we'll talk later about how you might have to adjust this. But look a little bit at your own kind of personal cash flow statement to figure out how much you should save. All right, so we're going to go through an example. Now, for this example, I'm going to flip back and forth between the PowerPoint and Morningstar Premium, just because we have a tool in here that helps you do it. But conceptually, hopefully, if you are not a trialist or a subscriber to Morningstar Premium, hopefully conceptually this will make sense. And there are free calculators online, so financial calculators, and I'll try to find one for you as well. That will help. All right, so here's our example across the top of the slide. So you want to retire in 20 years. You want to take 70% of your current income, and I'll talk about why this is important, your current income of $100,000 out of your portfolio on an annual basis using a 4% withdrawal rate. So let's go through a couple of these terms that we have in here. Hopefully the 20 years thing makes sense. Just pick when you want to retire and how old you are now. You can also find a calculator online to do that for you if you can't do the math. Let's talk about income. So many people, and the way that a lot of things are framed is they're framed in how much money you actually want to have in your portfolio. Now that's very difficult, especially with people on long time horizons, to wrap your head around what that actually means. We hear this stuff all the time that, some organization comes out and says you need $1 million in your super, or you need X amount of dollars in your super. And it's hard for people to understand. And it makes a lot of people give up when they have long time horizons because they don't see how they're going to get there. So instead, it's a lot easier for people conceptually to think about how much money they want a year to go into their bank account, right? Many people have jobs. They can certainly figure out what is the lifestyle that a certain amount of money will get me. So that's why it's good to use that number, right? So 70% of your current income. A lot of people take a discount. This is all personal circumstances. Take a discount to what they're currently making because there are some expenses you don't have to pay in retirement. Namely, super contributions, right? You don't have to make super contributions if you're not in retirement. So that shaves off, depending upon how you get your salary quota, that shaves off, over 9%. Commuting costs, perhaps, are different. Now, the caveat, obviously, is this is personal. Depends what you actually want to do in retirement. If you're planning on traveling a lot, hey, those expenses might actually go up. But anyway, taking a percentage, whether it's 70% or 120% of your current salary, is a good way to conceptually look at this. The last thing on here is the withdrawal rate. Now, the withdrawal rate is really important, as we'll see, because you need it to actually do the math to translate how much you want a year coming out of your portfolio into how much needs to be in the portfolio. So the withdrawal rate is simply the amount that you're going to take out every year. Now, we chose 4% for a reason. There is the 4% rule is a pretty famous thing in investing and personal finance. And where it basically came from is there was a financial advisor in the US that was trying to answer this same question. So this is back, I think this was in 94. And, every day he'd have all these clients come in and trying to figure out a safe withdrawal rate for them. And the reason that you need a safe withdrawal rate, obviously, is because when you stop working, it's kind of a zero-sum game where you will die at some point, and you have no idea when you will die, and you'll run out of money at some point. You don't want to run out of money before you die. And it's very hard to deal with when you don't know when you're actually going to die. Life would be easier if we knew when we were going to die. But what he did is he went back and he looked at historical market returns. And he basically ran something called a Monte Carlo simulation, which is just all different permeations of combinations of returns across different asset allocations. And what he came up with is the vast majority of the time, for the vast majority of people, 4% is a safe withdrawal rate. Now, the problem with what he did is that he did it, why it's pretty controversial now, is that he did this in the early 90s. And return profiles were very different then. Number one, interest rates were higher. You actually got some money out of cash and fixed interest. Not necessarily happening anymore. The market's been on a huge run. So valuation levels are very different. So a lot of people say that withdrawal rate should be more conservative. So literally just Google 4% rule, and there will be articles all over the place. If you Google Morningstar 4% rule, we have a ton of articles on it. But no matter what you pick, you need a withdrawal rate. All right, so now we just do a little bit of math, right? So if we use that 4% withdrawal rate, we look at $70,000 a year. Oh, sorry. The first thing we need to do is look at inflation. So you want $70,000 a year in 20 years. Now we know that $70,000 is not going to have the same purchasing power in 20 years. So we need to change that. So I assumed in here 2.2% annual inflation. You can pick how conservative you want to be with that number. So what that means is in 20 years, I need $107,000. All right. So all we're doing is we're dividing that $107,000 by 4% or whatever withdrawal rate you need. And we roughly come up with 2.7 million. So we talked about the time horizon, 20 years. So you're 45, you want to retire at 65. You have $450,000 in your super, but you're going to continue to save. So you're going to save $7,000 a year in your super. So there we go. We have now come up with every single number that we need to calculate a required rate of return. And let's talk about this required rate of return. And we'll get into the portfolio stuff in a second, but this foundational bit is important. So what is a required rate of return? Well, basically all it is, and we've got a formula up here. Don't worry, we've got a calculator for you. All it is it is connecting where you are today with where you want to be, given all those other inputs, how much you're saving, how much time there is, how much is in your current portfolio. So by calculating it, you get to do a couple different things, and I'll show you on the website in a second. Number one, you get to see if your goal is actually realistic. So if you calculate a required rate of return that is 40%, you're not going to achieve your goal. Unless you're a lot better investor than I am or most people in the world are. So the point is it shows you, just by going through this exercise, it shows you that your goal is either realistic or not realistic. And we've all done that. We've all sat there with friends and had them describe some sort of what you think is some fantasy future outcome that you don't think they're ever going to get to, that they're going to buy an island in the Caribbean, but they're not saving any money and they only work half a week. Going through this exercise will actually show you if your goal is realistic. And the good thing is you can make adjustments, as we'll get into in a second, to see if it's realistic. So that required rate of return, and we'll talk about this too, is the average rate. So that's the return you need per year to hit that goal. Now, let me show you how you actually do that. So this is always tricky when I try to switch screens, given the fact I'm not very good at this. I could make this a little easier. Oh, there we go. I could also have less windows open. All right, so I'm going to go on to our website. So here you go. I'm going to go into track investments and rate of return calculator. So let's go through this same goal. Let's see if I remember everything. All right, so we have $450,000. Sorry, my laptop's far away from me because our event staff came in who stole Will from me today, and they added this weird halo light, and we had to put it on my computer, so now it's far away. All right, we wanted 2.7 million. Inflation, we've already taken into account. We could do this before inflation, where if I put in something, so if I put in that 2.2%, what that's going to do is it's going to give me an inflated value. Now, it's not much because it's only 1 year, but if I go 20 years, which is the next thing I'll do, yeah, so you can see there's a big difference over time, but we've accounted for inflation, so I'm going to take that away. But you can account for inflation with that future value, right? So if I took 4%, well, I'll do it. How about that? So if I took, we want 70 grand a year. So I'm actually using a calculator on my screen now. You just can't see it. All right, so if we do $70,000 a year, which is what we wanted, and then we divided it by 4%, we got 1,750, so 1,750,000. All right, so that's giving me that future value. But we've got 2.2% a year. So basically we're right up there. That same number is on the slide, close to 2.7 million. All right, 20-year time horizon, but we're saving. So we're gonna save, we'll put it in annually, although you can put it in monthly if you want that extra compounding. We're gonna save $7,000 a year. And what is this calculating? It's calculating 8.6%. So that means we need to get 8.6% in order to achieve our goal. Now, I will say 8.6% is pretty high, given where we are, given where interest rates are, given the valuation levels of the market. But anyway, we didn't put an alert on there, but I will say, no, even that wasn't enough. I changed. I'm just going to show you one of our features. All right, 11, that's really high. So we actually say to you, yeah, you're definitely not going to get that. But good luck. Anyway, I'll go back to the original piece that we had. All right, anyway, 8.6% a year. Now you can also do this online. If you just find a financial calculator, you can do that. So I will go back to our PowerPoint. All right, so you've got 8.6%. Now, one of the really good things about calculating your required rate of return is then you can see if you are on track to achieve your goal. And you can do that by looking at the actual returns that you achieve versus what you need to achieve. Now, it's very difficult for people to do this if they're not using that required rate of return. And it's really difficult to do that because how are you supposed to know with a number if you're actually getting closer to your goal? So even if you defined it, you need $2.7 million. When you're in year 16, how do you know how much money you actually need? So it's good to look at that required rate of return, and it'll also get you to do stuff. So let's look at an example. So what I did is, and the first time I gave this was back in April of last year. So what I did is I pretended that whole scenario we went through was 10 years before, so 2010. And I pretended 10 years afterwards, I wanted to go and look at how I was doing. So April 1st, 2020. Now, just for simplicity's sake, I assume that we invested all of the money, and we would never recommend this because it's very concentrated, not diversified. But we said invest all of the money in the Vanguard Australian shares ETF. So over that 10-year period, from April 1st, 2010 to April 1st, 2020, it returned 7.72% a year, which is pretty good, right? But it is behind our goal. So we did have a pretty aggressive goal. So what's happened during that time? Your portfolio has gone up from 450,000 with that additional savings to a little over $1 million. So that's good. You're a millionaire now. You're still saving the same amount of money. So even though your portfolio is doing well, you have not gotten a raise. You're saving that same amount of money. Now you've got 10 years left. Your goal is unchanged. It's still $2.7 million. So I can go back and recalculate that required rate of return. So what is my new required rate of return? It's 9.5%. So that's a problem, right? It is obvious now that you are falling behind. And if you didn't do this, you might think you're doing pretty well. You're a millionaire now, like you must be on your way. You've more than doubled your portfolio in a 10-year period. Like, sounds pretty good, right? But in actuality, you're falling behind your goal with that 9.5%. So now let me go back. This is just us flipping back and forth. We allow you to do this on premium. So I am going to get rid of this. And I'm going to look at something I set up earlier. So what we do is if you can save your goal, you can also attach your goal to your portfolio. So now you've got an actual return coming in. So what I've done is I've tracked this. So I set up a goal on here, and then I've linked it to a portfolio called retirement. And here's retirement, right? So when I set this goal, I had a certain required rate of return. Now, in this case, I put in more money into this, but the return is not good. So between November and February, the return of this portfolio is not good. But what this allows me to do is automatically do this. If none of my goals have changed, I can look at my current required rate of return. Now, more money has gone in this than it said was going to be saved. because I actually had a $0 initial investment. So it's gone down, but either way, you can just look, what was your original required rate of return, what is your new one? And this hasn't really changed, so I wouldn't really do anything in this case, but it does allow you, premium does allow you to do that. So I think it's pretty cool, but then again, I was the one that told the team to build it, so. All right, so what does this allow you to do? It allows you to do something to try to actually achieve your goal if you're falling behind. So what are your choices? Well, any of these variables, not getting into too much math, any of these variables, adjusting any of these variables that go into this formula up here, basically a future value formula where we've rearranged that to look at I, this required rate of return. Any change in any one of those variables will change the amount of money that you'll have in the future. But if you're keeping that constant, it will change the required rate of return. So how do you get back on track? And in this case, back on track is getting back to this original required rate of return. All right, so let's look at the different things you can do. You can save more, right? So that's always an option. You can save more if you're falling behind a goal. So in this case, you can increase your savings to $20,000 a year. Now you're saving $7,000 a year now. So yeah, that's a big increase. So maybe cutting back on a cup of coffee every day is not going to do that for you, depending upon where you buy coffee. But yeah, you can increase your savings. You can delay your retirement, right? So we've set a time period. It's 10 years now until your retirement. You can delay your retirement. And we hear about this all the time, but you can make a conscious decision 10 years before retirement that, you know what, I'm not retiring at 65, I'm retiring closer to 66. You can delay it by 11 months. You can, well, we'll get to this number 3 next. You can reduce your goal, all right? I'm falling behind, but maybe I don't need $2.7 million in retirement. Maybe I need less, right? So I no longer want to do X, I'll make this sacrifice because I don't want to save more now. I don't want to do anything different. And then we've got this right here, invest more aggressively. So let me talk about that for a second. Now, in this case, I use a simplified example, putting all of our money into equities, into Aussie equities. Obviously, we would never recommend to do that. But the asset allocation mix that you pick, there are expected returns with different asset classes. So the mix that you pick is going to have a huge influence on how much money you actually have in the future. So going further out on the risk spectrum, and I don't mean buy GameStop options, but moving more money into equities, into growth assets versus defensive assets like fixed interest and cash, moving more money into equities is investing more aggressively. Now, the reason that I really like this approach is because what happens when the market falls? When the market falls a lot, people get panicked and generally they sell. Even people that know they shouldn't be selling, they see their account balance going down every day and they are worried and they sell. That's the opposite you should be doing, right? So when the market is going down and valuations are getting cheaper on equities, you should put more money into them. Using this approach will actually make it very concrete that that's what you should be doing. So picking a more conservative asset allocation by selling your equities and going into cash is actually going to get you further away from your goal because your expected return will be less. So hopefully that made sense, everybody. That's one of the things I like about this approach. All right, so that is that. Let me go back to the website and let me show you a couple other things. All right, so let's talk about this actually building a portfolio. So we've gone through this whole process and we've come up with a required rate of return. So in this case, we've come up with 8.6%, which I think is pretty aggressive. But what that allows you to do is start thinking about asset allocation. Now, once again, asset allocation is just a mix of different assets. So let me show you a couple examples. So we have a couple suggested portfolios. So I'll go to aggressive. And even with that 8.6%, given sort of valuation levels, we don't feel like that's achievable at this point. I'm on all these investing forums where I see these statements about, oh, you should invest in this because you'll get 20% a year for the next 10 years. It's pretty scary, but I guess when you've got a bunch of investors that have not seen a bear market, there's a lot of overconfidence. But anyway, Asset allocation. So this is our most aggressive suggested asset allocation here at Morningstar, and 90% of the assets in here are in what we consider growth assets. So that's Aussie equity, global equity, listed property, global listed property, global infrastructure. And then there's 10% in what we would consider defensive assets, fixed interest. You can read them both, domestic and international fixed interest, and cash. So what does this mean? It means that you can now make an informed decision based on the required rate of return that you need to achieve in how you actually set up your portfolio. So this is where we're making the connection between you and your goal with how you're actually investing. So instead of watching commercials about ETFs and listen to your mate at the barbecue tell you about some great ETF, you can link what the investments you pick are to your goals. And that is the whole point of this. So the first thing you're going to want to do is you're going to want to set an asset allocation strategy that you want to use. Now, even if you've been investing for a very long time, you can still do this, right? You can look at how your portfolio is actually allocated right now. My boss just walked by, gave me a weird look. But you can look at how your portfolio is actually invested right now, and I'll show you a way to do that in a second. And then have a goal asset allocation. So when you're making decisions in the future, whether that's decisions on money that you're investing in the future, you can start tilting your portfolio to where you want to get it. So start with asset allocation, then you can start thinking about investments, right? So all of a sudden, if you decide that 30% of your portfolio needs to go into Aussie equity, that can give you a basis to start looking at the different ways that you can access Aussie equity. So whether that's an ETF or a fund, or you want to pick individual shares, that's going to give some structure to what you're actually doing. And structure, as much as I dislike structure, structure is actually really important in investing because it stops you from doing things that could be detrimental to your future returns. All right, let's look at one more thing. Oh, so I told you I would show you how to look at your current portfolio. So if you set up your portfolio on ShareSite and it gets brought back into premium, you can run something called an X-ray report. X-ray report it's exactly what it seems like. Just like when you go to the doctor and you have an X-ray, it's going to actually look through your portfolio and it's going to tell you all sorts of different asset allocation stats, but it'll tell you, and this is a boring one because it's all international equity. I need to set these things up better. What it's going to show you is how your money is actually allocated, and you can dig into it as well. Stock sectors, different regions around the world, look at stats, style box. So we talked about growth and value and small and large cap on Tuesday. So anyway, there's all sorts of information on here, but what it does is it'll give you this snapshot right there. So you can look at your own asset allocation and compare that to the asset allocation that you have as a target. All right, the last thing I want to say, this is not about picking investments, but then once you understand what you're doing, say you want to use ETFs, then we've broken down everything into those same categories. So, Aussie equity ETFs. Remember, we want to put 30% of our portfolio in there, so I can look at the ones that Morningstar rates. Same thing, global equity, et cetera, et cetera. So I can go through all those different asset classes, all the ones that are on that original chart. So that allows you to have a little more structure about how you're picking those investments. And my last plug is for, if you go into Learn to Invest, by the way, this is where the videos are of all the previous webinars. Go into Morningstar Invest. Shani, the birthday girl, wrote Morningstar Guide to Selecting Investments, and it will go through a structured process in this guide. And we'll do a future webinar on this. How do you actually decide whether you're going to buy, whether you're going to use an ETF or a fund or individual shares? So that's my little pitch for her on her birthday. It is a really good guide. We've got a podcast episode of Investing Compass on portfolio construction that actually walks through that whole process. All right. So Linda's saying that it sounds like I'm speaking in a bathroom. Yeah, so I'm sorry, you probably weren't on in the beginning. This is temporary, one-time thing. I'm by myself now. I'm just in a room on a Zoom screen setup. We will be back for the rest of these in the boardroom, which is better sound, and we've got Will and microphones. So I am sorry about that, Linda. All right, so. Okay, so we've got a good question from Dylan saying you mentioned 8% is too high, an expected rate of return. That's a personal opinion. It's also a Morningstar opinion, but what is the expected rate of return for your conservative versus aggressive portfolios? That's a very good question. All right, let's go back to the website. And Lisa said, happy birthday, Shawnee, which is nice. But you did not say if Nino said happy birthday. All right, so where were we? We were in asset allocation models. All right, so let's look at conservative. So the way that we look at these things is we look at it CPI plus. So CPI is inflation. So the consumer price index. So we're looking at a CPI plus range right there. So conservative, we'll go into conservative. So CPI plus 0.5% a year. So very, very low. So we at Morningstar, that 2.2% is our long-term estimate on inflation. And there's a lot of opinions about inflation, but anyway, that's ours. So 2.2% plus 0.5%. So we're looking at returns of 2.8% a year. If we look at this conservative portfolio, the vast majority of it, 90% of it, is in fixed interest. And then we've got, looks like we got 13%, so sorry. 87% is in fixed interest. Then we've got 15%. I can't do math. Anyway, we have 15% in growth assets. So that is, that's the very conservative portfolio. So if I go back, and we go up to aggressive, we got CPI plus 4%. So that's looking at 6.2% returns. Now, people will tell you that we're crazy for thinking that, and maybe we are. Really where that comes from is the level of interest rates, what interest rates has done to increase asset values, and just the fact that you're not getting anything practically on fixed interest or cash. So yeah, that's where that comes from. Just so you guys know. All right, got a couple other questions. I will stop share. If I have this weird halo light pointed at me, we might as well put me on the screen for some point. Okay, well, this is an easy one. Angelo is asking me, how do you get access to this website? All right. See, I stopped my share too soon. Yeah, it's pretty simple. So the website, I hope, home. Premium.morningstar.com.au. So if you go there and you don't have a premium subscription, you can simply sign up for a trial. So you get a free 4-week trial. We don't take your credit card or anything else. That's the most salesy thing I've said on any of these. But that's how you get access to the website. So you can email me also if you have any questions, and I will walk you through it. I'm just hitting the wrong buttons. I really can't be trusted to do these on my own. All right. So, Nino is in a thunderstorm. That's not good. Okay, so we've got a question. Where can I see all the stocks in Morningstar Premium whose star rating has recently changed? So you're getting questions about the website. Okay, so we are building that. But what I will say is what you can see, and it's particularly busy right now. So we are building an alerting tool right now, so you can just automatically see things that are changed. But if you go into Stay Informed, you go into stocks, you can see our latest research. So it doesn't necessarily mean a star rating has changed, but you can go in and see what our analysts are actually publishing. So they're all sitting over there. They don't go to lunch for 2 hours. Like my team, but they're all sitting over there doing lots of updates because it is, of course, earnings season. But so you can see there's a lot of reports that came out. You can see all our latest research reports. So normally when it's not earnings season, you're going to see less. But if you go into each one of those, you can look at what our analysts think. So thank you for that. So we've got a question from our favorite attendee, the anonymous attendee. This says, does Morningstar track spaceship investments at all? So I do not believe, so through ShareSite, which you get as part of your Morningstar subscription, I do not believe there's any connection into Spaceship. So what you can do is go in there and look at the underlying investments that are in there, and you can enter them in yourself. So you can do that. All right. There are not very many questions today, so we might finish early. And so if anyone else has any questions, please send them through now. If not, we get to end early and I can have lunch before my next meeting, which is exciting for me. All right, if anyone does have questions, just please email me directly. So mark.lamonica1@morningstar.com. And yeah, we can go from there. So one thing I will call out, so on Tuesday of next week, I will not be here, but Peter Warnes will be here. So Peter Warnes is our senior equity analyst who writes the overview of Your Money Weekly every Tuesday, and he will be going through earnings season. So if you have any individual stock-specific questions, go and ask Peter Warnes. Oh, okay, so now I have more questions. Okay, so we'll just keep going. But anyway, you should join on Tuesday and see Peter Warnes. He ask him about any ASX stock, he will have some sort of answer. It's pretty remarkable. Okay, so we've got a question from Aruba saying, what is your view on robo-advisors? Okay, so we'll take a step back. What is a robo-advisor? A robo-advisor is basically, it's exactly what they say they're trying to do. So what they're trying to do is they're trying to automate that process. So basically that asset allocation process, the rebalancing process, and trying to take your goals. Now, a lot of them don't use goals. Take your goals, we'll just call it goals, I'll get into what they do in a second, and translate that into a portfolio, and then translate that into actual underlying investments, and then sort of take care of it, which basically just means rebalancing. Now, I think there's some really good things about robo-advisors, and there's kind of the famous ones that started in the US were Betterment, and yeah, what's the other one? Wealth, of course I'm forgetting the other name. Those are some of the ones that started in the US. Now, the only problem that I have with a lot of them are based more on a risk questionnaire at the beginning of them. So one of the reasons we really like goals is because traditionally, and a lot of advisors do a goals approach now. And Morningstar works with a lot of financial advisors, and that's the approach that we think you should take, and those are the advisors we like to work with. But the other way that people traditionally would go through this process is they use something called a risk questionnaire. And a risk questionnaire basically sits there and asks you what would happen if something happens in the market. And there's a lot of problems with using risk questionnaires. Number one, people don't answer accurately. So people either know what they should answer, and they'll just say that, and then they react completely differently when something happens, or they will set a risk tolerance that will never allow them to achieve their goal. So, the example we always use is like if you sat there and set up a questionnaire saying, what would you do if somebody pulled a gun on you? You can say whatever you want, but when someone pulls a gun on you, who knows how you're going to react? Right? So same thing with market fall. So people can sit there and say, okay, well, if the market goes down, generally the way they do this is the market goes down 40%, what would you do? And you can say, I would sell all my investments. I would invest more because the market's cheap. Regardless of what you do, when you're actually in that very stressful situation, you're probably not going to do what you say you're going to do. The other big problem with them, I mentioned before, is that let's say somebody goes up to you and they say, are you worried about fluctuations in your portfolio? And you say, yes, I'm really worried about that. I don't have much of a risk tolerance. I'm not going to be able to deal with my portfolio fluctuating a lot. Maybe you're completely accurate about that, but you still might have this goal of trying to get $2.7 million. And so if you look at the goal, you can frame that conversation correctly and you say, okay, well, if you want 90% of your portfolio in cash, you will never achieve your goal because you need an 8.6% return to achieve it. So I think by adding that perspective, it allows people to sit there and make a conscious choice that, okay, I want to keep most of my money in cash, knowing I'll never achieve my goal. So I need to back that goal way off. So that's kind of the problem that I have with some of the robo-advisors, that setup process. What I do really like about the robo-advisors is all the stuff that people either don't do because they don't want to or it's hard, namely rebalancing. They take care of all of that for you. And some of them have gotten very sophisticated in terms of like dealing with taxes as well, trying tax minimization. So I really like that part. If I was to use a robo-advisor, I would probably do this goal setting part on my own. And then what I do is I go in there and find a portfolio that they have in there that's appropriate, given the returns that I need to meet my goal. But that's a good question. All right, another really good question by Dylan. So I mentioned at the beginning, and Dylan picked up on that, how would I add variables into my investment goals, such as a home purchase prior to retirement? You're gonna have multiple goals. My recommendation would be that you should sit there and define each one of those goals. So go through that same process that we went through and figure out the return needed to get those different goals at different timelines, right? Because you can figure out how long you want until you get there. And then you can sit there and basically invest for each one of those goals. So yeah, it's going to make it a little more difficult for you to have sort of a holistic portfolio that will pay for both, but there is no reason that you can't either mentally or physically in different accounts have different accounts for different goals, right? So the simple one is retirement. You've got your super account. If you're saving for a house and you want to buy it before you can access your super, you're going to have to save somewhere else. So you can set up a different portfolio, a taxable portfolio, and save for that other goal. So, and you know, because there are different time horizons, use both to adjust your asset allocation appropriately. All right, so I've got this question from Michael saying, do you think saving because I can, so I think as much as I can is a real savings goal? So I think what you're saying is, all right, so people fall into this, people fall into these things that I'm saving as much as I can, and I want as much money as possible in the future, so I'm just going to invest really aggressively. Well, I mean, I guess that's fine, but you have no idea what you're actually going to achieve. So I think that the problem that you run into is, hey, some people save too much. And maybe that money is better spent. We talked about delayed gratification. Maybe the money's better spent, like my team, out at lunch for 2 hours on Thursday. Maybe that's a better use of your money. I think just going through this process at least allows you to figure out what your different choices, what impact they could have in the future. So even that $7,000 a year, right? So if you set a savings goal that you know will help you reach a future goal, then you can look at your individual savings in relation to that goal. So yeah, I think that's effective. All right, so we've got an interesting question from HC. So saying, assuming the recent trends in steepening yield curve for the US Treasuries continue, or not, reverse, what would be the effects of this on the valuation of equities and real estate assets? Okay, so let's talk about what a yield curve is, number one. So interest rates, I think I mentioned this on Tuesday, the markets recovered a little bit, had a really good overnight in the US, not so good in Australia, but yeah, so what has happened recently in the market is interest rates have gone up. So I think people are a little more optimistic that the economy is going to recover. And so interest rates naturally have gone up as that's happened, despite all the central banks and everyone else trying to hold them down. And equities have gotten, so stocks have gotten hit a little bit. So the market over the past couple of weeks. Now, when we're talking about yield curves, so interest rates, the yield curve simply looks at interest rates on different maturities of bonds. So in a very simple example, let's say you have a 30-year bond and a 5-year bond. The yield curve is simply plotting a line between the two. Now, normally, what the market should look like is there should be a yield curve where you're getting paid more to lend your money for 30 years than you are for 5 years, right? So that's more of a normal yield curve. Steepening is, of course, when those long-term bonds, those interest rates are going up even more. And so literally it's steepening if you think about a curve. And there's all sorts of plots along here. I'm just using 2 plots. A flat yield curve is, a completely flat yield curve would be when somebody's paying you the same amount of interest for 5 years versus 30 years. And then, of course, the inverted yield curve, which many people think is an indication there's a recession coming, is long-term rates are actually lower than short-term rates. Which is not a good thing. So what do I think in terms of interest rates going up? Interest rates going up are going to most likely lower the valuation of equities. So all the things that we talked about, how with equities, what we're doing is we're valuing future cash flows and discounting them back to the present. A lot of what goes in there is our interest rates. In terms of what that discount level is. So if the discount is higher, if the interest rate is higher, that means you're discounting them more. That means those future cash flows are worth less, and it brings down the valuation of equities. So interest rates going up are most likely going to have a problem with equities. They're also most likely going to make real estate assets go down. Because if you think about how everyone buys real estate, is they walk into the bank and they say, this is how much I make. How much can I afford to borrow? They tell you, and then you're like, all right, I can go buy a house that costs X. So if interest rates go up, if mortgage rates go up, asset prices are going to come down. I mean, it's just kind of going to happen. Now, nothing that has happened with interest rates yet, I think, is going to have much of an effect. I'm just saying, if this actually really happens and interest rates keep going up, it would probably have an effect. All right, a question from David about Bitcoin. So Bitcoin's always fun. I will say that we did a webinar on Bitcoin and we did a podcast on Bitcoin. So once again, if you listen to the podcast, that'll be Shawnee's birthday present. What do I think about Bitcoin being another bubble? Listen, it's hard to say from a price perspective. Listen, Bitcoin is not an asset you can value. There are no cash flows. It is driven solely by investor demand. It's gone up a lot. I'll just say that. Things that go up a lot, even if they long-term are going to continue to go up, I would personally be a little worried about Bitcoin, given how much it's gone up. All it takes is profit taking from people and starting to sell a little bit, and people lose confidence, it will go down. Now, it doesn't mean long-term it's not going to go up, but I'd be a little worried, but who knows? It'll keep climbing probably. I've got a friend who years ago invested in a little bit of Bitcoin. He sold his years ago, but one of their friends in the group kept it all. And my friend, I made disparaging comments about Bitcoin. He sends me a picture of his friend's portfolio every day. So it's going up a lot. All right, so a couple more. Now we have lots of questions. Okay, we've got a question. I'm just going to look for this. We've got a question about how you can go through that goal setting process. All right, I think I found it. Okay, I found it. So let me share my screen again. So I did mention, obviously, this is about helping people, not helping us. So there are ways to do this without using anything related to Morningstar. So I'm going to share my screen. So this is calculator.net. So everything that you can do on that screen that I showed you, you can do one, if you go buy a financial calculator, you can just do that. You can also find something online. Now, the issue is that a lot of the terms are confusing to people. That's why we try to spell out the terms on our website. So basically, if you go on to calculator.net, you go onto their finance calculator. So you can see up here, and I'll email this. If anyone needs this, I'll email it to you. You can do all the same thing. You just have to know what you're putting in. So N, when we say number of periods, we are saying years. So 20, present value. So PV, present value, that's how much we had. I mean, we don't have to go through the same example, but yeah, present value, that's how much money you have now. So in our example, what's in the super? Periodic payment, this is how much you're saving. Now, the tricky thing about this is it has to equal the number of periods. So I can't put in, unlike our calculator, you can do it, but you gotta sort of back into it. So you would have to put in how much you save per year. Has to match that number of periods. We're saying 20 is the number of years. So I'll just make some stuff up. Future value is how much you want. So that's how much you want for your goal. And then hit calculate. Oh, this is probably making me do things, everything negative, I guess I would assume. So this is another problem with these things. There you go. All right. So it's just a quirk that I won't bother explaining. But anyway, yeah, so you got to make both these numbers negative because the present value is positive. This is giving you that same thing. So this interest rate, that's your rate of return. So in my little scenario, you would need a rate of return of 26% a year for 20 years. So you can do that on calculator.net. I like ours better, but I'm biased because, you know, my team built it. But what we're trying to do is take basically a financial calculator, so a regular one or one online, and try to translate into something that is more helpful for people. Okay, so Lisa's got a question. She says, with asset allocation, how do you allocate an ETF? Yeah, so I guess what I would say is, you know, what we do and what I showed on the website is we obviously put those ETFs and funds within those different asset allocation buckets. So if you're not using our website, what I would do is simply go and look at the ETF and see how it's actually allocated. Now, those are very high level allocations, right? Global equities, domestic equities. So just go in and look at like the fund fact sheet or the ETF fact sheet, and it'll say, right? So it will say, this is a global ETF. We invest in all countries around the world. So then you know, okay, that goes into that allocation bucket of global ETF. That example I used, VAS, that Vanguard Australian Shares ETF, that is a domestically focused ETF. So yeah, you just go in and spend a couple minutes reading those. And there's other ways you can find it online. But yeah, basically just reading those, then figuring out what bucket they go into. All right, so good question. So we got Jeffrey asking a question. Could you cover using asset allocation for people in retirement? All right, so let's talk. Sorry, I was going to say this. We'll talk a bit about sort of approaching retirement and going into retirement. So what you're going to want to do, the sequencing of returns is very important. So we are dealing completely with average returns. So that is the average returns over the lifestyle or the lifetime of that portfolio, that 20-year period. The sequencing of your returns matters. So as you're going into retirement, or when you're in early retirement, when you first retired, if the market's doing really poorly during that period, it's bad for you. So if we think about the example of going into retirement, so even if you have the same average returns as somebody, you will have a lot less money potentially because you're stopping saving, you're starting to withdraw from your portfolio. It's going to hit you a lot worse than if you have 15 years to go, because then you have time to recover from that, and you're not actually pulling money out of your portfolio when it's down, right? So when you're selling stuff when it's down, you're taking money out, it means you have less money to go up when the market recovers. So what is recommended is obviously to make sure that you're not going to go through those hits right before you get to retirement or right when you're in retirement. And so people get more conservative. Now, what I will say is be careful about how conservative you get, because people are living longer. You can be retired for a very long time. And if you get too conservative, you're going to run out of money. So yeah, there is nuance in that. But you know, what I would do is, like in this example that I was using, so basically the way the 4% rule works is if you retire, whatever money you have in your portfolio, you take out 4%, and that's what you're going to spend in your first year. And then you increase that 4% by inflation. And you're increasing that amount that you're taking out by inflation. So if you're taking $100,000 out and inflation was 5%, take $105,000 out the next year. So you do get to increase it with inflation. But that is just a point that you are, a point in time where this whole goal setting process ends, but then it's important to start looking at other goals and going through that same process. And you're going to want to be a lot more conservative, but you can still have goals of growing your portfolio, right? You have goals of growing your portfolio in excess of inflation. So that's what I do. I just sit there and sort of recast your goals and go through that whole process of asset allocation. So your goal could be to double inflation, and you think that you're well placed to do that. So just go in and say, okay, well, my required rate of return is double what inflation is. I think inflation is going to be 2%. My goal is 4%. And that'll give you a more conservative asset allocation, but yeah, you can still do that. Okay, so we've got a question from DP saying, is there a point of diminishing return in an aggressive portfolio where the gain from more equities is not worth the increase in volatility? It's up to you. So what we're saying here is what we are trading for. The reason we're getting returns is because we're taking on risk, and risk is measured in volatility. So the more risk I take on as an investor, and I'm not talking single stock risk or options risk or something crazy like this. You're not going to find this on a Reddit board. But in terms of asset allocation, the more that I allocate into those growth assets, the more my portfolio is going to bounce around. But I'm getting compensated for that, right? Whereas if I invest in cash, I'm getting nothing. But I know the value of my portfolio is not going to bounce around, right? If I'm 100% cash, so I've got $20,000 in there, I'm going to keep $20,000 forever and get a little bit of interest on it. So you're getting compensated for that risk. So they are linked. So that's why I'm saying it's up to you. There could be a point in your life where it is not worth it. And the point in your life is particularly as you're approaching a goal where that volatility can really knock you for a loop and you won't actually be able to achieve that goal. So yeah, that's why people talk about sort of this glide plane where over time, as you're getting closer and closer to your goal, you want to get more conservative because you don't want to put up with that volatility. The other thing I would say is when you go through and you do that goal setting process, you can figure out that you're taking on too much risk. I mean, that's like entirely possible as well. I use the example of a lot of people say they're very risk adverse and they're never going to achieve their goals because they won't get high enough returns. There are a lot of people that are taking on too much risk. So maybe their portfolios shouldn't all be in equities if they have a fair amount of money compared to their goal, and they're actually pretty close to achieving it. They only need 2-3% a year to achieve their goals, and maybe you're taking on way too much risk. So that trade-off you're making between risk, so volatility and reward, is out of balance. All right. So Angus is saying 4% withdrawal is a bad example. Minimum withdrawal at age 65 equals 5%. Okay, so let's, those are two different concepts. So just because they make you take money out of your super, so that's what you're saying with that 5%, just because they make you take money out of your super doesn't mean you need to spend it. I'm talking about spending the money. So I'm not looking at tax environments here. Obviously, that's really important. But you can take money out of your super and invest it somewhere else or keep it in the bank. You don't have to spend it. So that 4% withdrawal rate was all I was looking at there is what makes sure you don't run out of money. So sort of government mandated minimum withdrawal rates are doing something different, right? They're not looking out for you. They are making sure basically that people don't lock a bunch of money up in a tax-free vehicle and then pass it on to someone else. They want you to actually take that money out. So that's what that is. So in Australia, yeah, there are certainly minimum withdrawals, but doesn't mean you have to spend it. So I was just talking about like what money is literally going to come out of your portfolio and then get spent at wherever you go, restaurant, trip, anything else. So that's all I was talking about there. But I should have mentioned that. All right, so I'll finish on this question, which is difficult to answer, but the anonymous attendee is asking thoughts on what I should do if I could come into a large sum of money suddenly. Should I continue to invest monthly to average down, so that's dollar cost averaging, or plunk it all in right away? Is my investment horizon at least 10 years away? Okay, so what I would say is a bunch of studies, Morningstar has done a bunch of studies on this, looking at dollar cost averaging versus lump sum investing. So should I put a little in periodically, or should I just invest it all? Now, the studies looking over time all indicate that you should just invest it all immediately. Now, the reason that is because over time, the stock market has gone up. Most of the time it goes up. There have been positive returns, average returns, for a very long time. So mathematically, it's always going to make sense to put all the money in right now. Now, the problem is there are a lot of times where it would have been a terrible decision to put in the money, but the studies still show us that most of the time you should do that. You would put all your money in before the 1929 crash, or well, more recent stuff, before the dot-com bubble burst, before the GFC, would have been a terrible idea. So that is the problem. So personally, I think, I would think that even though I understand why all the studies tell you just to invest everything right now, for a lot of people, dollar cost averaging is probably the less risky way of investing, and I think people are certainly attracted to that. So yeah, it's certainly up to you. All right, what else do we have? We're out of time. Okay, there's a couple other questions. Please send them to me over email. So it's just mark.lamonica1@morningstar.com. So I'll be back next Thursday, and maybe, I don't know, they asked me to be at the beginning of this Peter Warren thing, so maybe I'll be on Tuesday for a couple minutes. But either way, tune into that and send me any questions or comments you have, or birthday wishes for Shani, or listen to our podcast and leave a comment, and that can be your birthday present to her. So thank you guys very much for joining.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.